Hello, everybody. Thank you so much for being here. It is Sunday, and this is an action-packed show. Again, we'll talk about some of the topics we're going to go through. People are asking about what to do with their Polkadot. We'll look at some pair trading. We'll look about what to do with their Polkadot, which includes layer in, layer out, stop losses, how to buy, how to sell, etc. A lot of questions regarding that. We'll talk a little bit more about the impact of the banking collapse on Bitcoin, on onramps, on the banking system shutting down entirely. Everybody's very, very worried about that. We have a lot of questions regarding financial advisors, inheritance, what to do with that, question about leverage and getting wiped out. We talked about that too. And we talk about a real estate question. You know, is it possible to do a fixer-upper in 6 to 8 months and flip it? And what will the market look like in that time? So the gamut is huge, over 50 nuggets. Let's jump in. And of course, now this is financial advice. I'm not a financial advisor, just a guy on the internet. But when you see the type of information that comes out from monetary news and internet and so-called experts and professionals and even the Fed, wow. I'll just leave that there. So, and all the questions as well come from this wonderful little community, the biggest financial community on earth. In Patreon, we got some room left. This typically sells out in bull markets. But again, lots of great minds, great souls, very sophisticated people, and a huge amount of knowledge sharing. 2.5 million plus posts in less than 2 years. So let's jump in. First question of the day is from Natasha Sakota. I have 3,000 DOT bought at average of $34. Would you convert them to Bitcoin or ETH given the halving and the fact that DOT has a lot of developers, but little adoption at the moment? Well, first of all, that is a very good question. And we'll break down exactly where we are with Polkadot right now and look at some pairs and talk about the good, the bad, and maybe if there's any ugly. So first of all, let's look at the Crypto Compendium score. They ranked 8 out of 28 in their peer group, which is smart contract platforms, layer 1s, layer 2s. They have a good inflation score. They've got good Nakamoto score. They've got good distribution. The whale allocation is something to be desired, of course. The ATR is bad, etc. That's the compendium side. And on the SCP side, as we call the smart contract platform profiler, DOT has great technology, great development, great growth opportunities, but zero adoption. So we look at, I talk about my three-legged stool. When we analyze things, we take many, many different parameters and put them into kind of 4 or 5 different legs. And this is kind of the problem. They are very good, but sometimes the best technology, the best platforms, etc., if they don't get adopted, they can shrivel up and die. And that's the biggest concern. Let's look at a couple of pair charts here. This is, and we're going to be talking a lot about pairs because, as I say, everything is a pair, ladies and gentlemen. Not the fruit, but everything is divided by something, whether it's a currency or a Bitcoin or whatever. So Polkadot over Bitcoin is down 77% over the last 550 days. And you can see the trend still continues down. Did have a bit of a rampage early 2021. And one of the things I discussed many times is the fact that the older tokens tend to run first in new bull markets. I'm excited to see what will happen this time around. I think new stuff is being adopted much faster than the old stuff, and it tends to run much faster too. Even meme tokens, which you won't talk more about. But the other red line on this chart as well is the 200-day moving average. And again, the trend is nasty. Can it break this trend? It's not looking likely. Now let's look at Polkadot versus ETH. This is down 88% in 800 days. This is even worse. And you can see that there was a bit of that rampage very early 2021, but since then, down into the bottom right corner. So from that perspective, it's really kind of not a good picture. And a lot of people sometimes believe hope is a strategy. It will rebound one day, but the answer is sometimes things don't. Sometimes they're just dead forever and will shrivel up and die slowly. So be careful. I can't tell you what to do with your bag, but I can tell you until adoption happens, it will be a ghost mole. And ghost moles have no dApps, no customers, etc. And there's many of those out there. Watch where the users are going. Look for the breadth of dApps, the breadth of use cases, look for the adoption. It is absolutely critical. And even though the market may not reward these types of fundamentals, they will in time, because at the end of the day, the data will prove out to be correct. So just be careful of ghost chains and just look at these two charts, and that will tell you where you want to be. And if you believe for a second that Polkadot could outrun Ethereum, it might in the short run, but over time with its deflationary situation, etc., I don't see that happening. Thank you so much for the question. Next question is from, let me see, Rib71, or is it RLB71? How can I use the layer out model to find entry levels for limit orders with high chances of getting filled? So I'm going to run through a couple of examples. I'm going to talk about how it can be used, first of all, what it's for. It was originally designed to help people take profit in an optimal way, but it can also be designed for scalping different layers over different parts of time. It can also help where to place stop losses and where to place limit orders. Let's go through some examples. Let's look at Tesla first. So this would be an example of where you could buy and where you could sell. You can see, and the reason for this chart is, Tesla went through a horrific last quarter of 2022. It just tanked. But look at the way it does stop at these lines. So you could say, well, it bounced off layer 6, layer 5, and then crashed all the way down. But the key is to watch the trend and don't get in, don't buy if the trend turns. And if the trend turns, set your stop loss to get out. And then on the rampage on the way back up again, Tesla went from like 103 to over 200 in a matter of weeks, and it took a lot of people by surprise. But since then, it's been tailing sideways. So if you look carefully again at this, you will see a couple of places where you can place limit orders. It just missed that 5 level and then shot back up again, but then fell back down again, and not only broke through layer 5, but also layer 4. So the key with this here, with the trend, is to wait for the trend to turn before you jump in. And that would keep you out of buying at layer 6, waiting for layer 5. So that's one example of how you can use them. And regarding Bitcoin, this will show you where there are buy and sell layers. So for example, if you are stacking Bitcoin and you don't know where to place your limit order, you can use this chart. So if we look back at the good old days before, again, the big banking crisis, which triggered a Bitcoin rampage, you can see exactly down at the layer 1, there was times where it hit, and this is the daily chart. So although the tool runs on the daily only, there's huge swings that pierced this layer 1 back in early Feb, also pierced it again and triggered a sell order not only late January, but also mid-Feb, and then fell back down again. And the undulations are incredible. You can also tighten the amount of time that the data looks at to calculate exactly what the layers look like on a shorter period of time. And once again, you'll see the sell limit. I've been talking about that 30,300 layer for a long time. That's where it comes from. That's where we face huge resistance. And of course, if you see 27.6, that's the support layer. That's where I find them too. So things tend to bounce around in between those layers, and that's how you use it. I'll go through some more examples as well to show you how it could work. And again, just pulling it out, you will see where most of the price action, most of where the resistance is. For example, let me see what layer is that, layer 2 for Ethereum, and then it bounces off the layer 1. And it nearly fell all the way down to the layer 0, which would be a Pico time to buy at about 1380. And since then, also, just like Bitcoin, went on a rampage all the way up to layer 6 and then fell down, pierced layer 5 and layer 4. And layer 4 is where you place your limit order at around 1845 right now. So that's how you use it. Let's look at Solana as well. One other example. You got your buy limit order, bounced perfectly off that 17.35, and you can see the action on layer 1, 20.2. Other layers shot all the way up to 24.6, 24.8 at layer 4, hit a lot of resistance, fell back down, and again, just like Ethereum, pierced 2 layers, smashed through layer 3, landed on layer 2, and has been bouncing off layer 2 now for a couple of weeks. So that's how you can use it. And it's very helpful not only to place stop losses, but also where to snipe, because you know where it'll congregate, where the price action happens. Thank you for the question. Next question is from Crypto Enthusiast. A big chance we will see more banking collapses in upcoming months. The upwards effect on Bitcoin is serious. I'm considering selling part of my Tesla shares, 85%, with a break even at 177, or my Tesla January 24 call option, which is at $165 strike price, and put that into Bitcoin. Do you expect Bitcoin to outperform Tesla in the coming months? Unfortunately, no additional dry powder. So crypto enthusiasts, you're doing a lot of what I do. I swing back and forth between assets when I can. But let's talk first, before we jump in, about the potential of the banking crisis. This guy, Hugh Hendry, had he's been on TV a lot over the last couple of days, and he is concerned about many things. He is a hedge fund manager. I think he's from Glasgow, Scotland, so shout out to anybody here from Scotland right now. And he warns that the US government may freeze American bank withdrawals. And when you think about that, that sounds like a bit of fear-mongering, fear porn, whatever you want to call it. But let's dig into what he thinks. So he says it's because of mass panic and capital flight away from the US banking sector. That has not slowed down, so he is correct there. And then he says there is a further decline in M2 money supply that could convince the government to take this step. Remember, M2 money supply has fallen, I think, 4% this year, which is huge, and it's historical. Also, Hendry, and by the way, a 4% drop in money supply is like a 100 basis point increase in interest rates. And Hendry also said that capital flight from US banks is not solely about fears of whether the FDIC will insure deposits above 250K. It's also about chasing money market funds' higher returns. And without a banking system, the economy is toast. And this is the problem. And Hendry says his go-to is both Bitcoin and US Treasuries for safety. So you're kind of correct in the fact that if things do get bad really fast, we could see a massive spike into Bitcoin, and that could drive the price crazy. But the way I look at this is a little bit different. I think we need to look at the impact of what is really going on. And you'd think that the Fed would understand this, but they've proven themselves to be wrong time and time again. They're always late. They're always wrong. They look at silly data that's old and aged, and they are, They are not practitioners, but they are academics, and they're clearly clueless. But the key ratio we need to look at is M by V equals P by Y. So basically, M is the money supply times the velocity of money, how much it's active. Right now, people are afraid, so they're not spending money. So V is going down, and so is M. This is the danger, because the other part of the equation, P equals Y, P is the price level. Obviously, that's tanking. It's going deflationary, many assets. And Y is the real GDP. So when you have the money supply going down by 4% and nobody's spending, GDP is going to tank. And this, combined with the banking crisis, is going to smash everything. And I think, although Hugh Hendry didn't mention that, I think that's the biggest concern around the M2 and why the US government, etc., could put a clamp down. It's highly unlikely. If that did happen, it would destroy all trust that Americans would ever have in the banking system and the government. And then Bitcoin could go to infinity. So you're kind of right there. But let's look at some charts. And the chances of this happening are very small. I think 1%, maybe 5%. That's it. But let's look at the pair chart. I did say we look at a couple of pairs today. This is the chart of Bitcoin over Tesla, and it's the daily chart. And obviously, we were at the top of the range. But what exactly does that mean? Let's flip forward to. I always look at roofs and floors, and floor I misspelled, of course, just like the Bitcoin dominance. But the roof here is about a 180-ish, and the floor is about 80-ish between Bitcoin over Tesla pair. We are at the roof. Typically, that's the time you flip Bitcoin into Tesla, not Tesla into Bitcoin. So from that perspective, I'd be a little bit careful. In addition, when we look at the correlation coefficient, you can see they're not entirely correlated. They're both risk-on assets. So from that perspective, yes. But there are times when one moves and the other one doesn't. In fact, what I've noticed lately is Tesla runs counter to the market pretty much for most of this year. If the market's tanking, Tesla goes up. if the market's going up, Tesla goes down. It's kind of bizarre. So there's weird stuff going on. And again, as I mentioned, the monetary media is clueless about Tesla. They don't understand what it is. And they're funded by other advertisers or whatever else that have them pushing their own kind of agenda on stocks. And that's the weird thing about the world today. Everything you read, everything you see on TV is most probably a lie. So in summary, if I look at my price targets going out a year from now, and this could be a year and a half from now. We'll just say April 2024, because I do believe Bitcoin could hit 42K by the halving date. Some people think it could go to 64. But either way, conservatively, 42K is a 44% gain from where we are today. And I think as we see things develop in the Tesla world and what's happening with their competition and what's happening with their margins and their other products that are coming to the line, I think Tesla could easily be $340, which is a 100% gain by April 2024. So from that perspective, I still, to answer your question, over the next year to 18 months, I think Tesla has more upside. But Bitcoin has that wild card, that is the monetary system is falling apart. The banks are falling apart. The world is built in a house of debt. It could all implode at any second, and that would drive Bitcoin to infinity. So that's the risk you got to take. That's why I play with both and swing between both whenever I can. So I hope that helps. And these are sandbag targets, could go a lot higher. Next question is from P. Solis. How are banks connected to exchanges and Bitcoin on-ramps like Strike app? If we have cash held at an institution where the banks they use go under, how does that impact the end client? I am a Strike user in the US, but I'm unsure whether to continue depositing funds through Strike due to them using Cross River Bank and the fears around it. So there's a lot of questions we'll see today about the paranoia people have, and that is a good thing. It's good to be afraid because, again, it takes a lifetime to make wealth and a second to destroy it. So let's dig into fiat on-ramps and FDI insurance. We'll handle this briefly, but Strike is known as a money transmitter. Okay, it's not a place where you really deposit stuff for the long term. It's licensed also as such in most states. And money transmitters are a type of financial entity that provides a service for transferring money from person to person. And there's a lot of other names for things like Strike in Europe. I can't remember the one that people use to pay for bills at restaurants and stuff. But these are considered non-bank financial institutions, and that means they are not FDIC insured, as they are not banks. And I'll drop a link later as to how you can find more information about this. But if you go to strike.me and /legal/terms of service, TOS, you will see a lot of stuff in there. And as a Strike user, I would not keep funds on Strike. I do use it, but it's just for transfers. You do not park any money there. And it's not intended for you to keep a large amount of funds on there either. And what you want to do is deposit funds you want to exchange for Bitcoin, or that you want to send to other people's wallets, and then make the transfer or withdraw to your own hardware wallet. Do not keep your funds on Strike, and either keep it in your bank that is connected to Strike, or exchange to withdraw to your wallet. And that is the way the money transmitters are intended to be used. So just be careful of that as well. Next question is from Straightjacket. This is, can you explain how leverage longs and shorts work on BTC? Are you not betting against the exchange? So great question. We have a new tool coming called PTOS, which will help people go long and short inversely correlated assets without having to use options or leverage. So it's a really cool tool coming out for those that aren't options players, but you could also use it with options too. But before we jump into that in a future episode, this is what, first part of your question is, are you not betting the exchange? No. So an exchange is how they match buyers and sellers. You go there, and that's why sometimes when I'm trying to fill, say, a big option order, there's no buyer. So there's no liquidity, and there's nothing I can do. There's no way like Ameritrade or another exchange would actually take that bet. So you are not betting against the exchange. But when you open a leverage position, you are betting against the market, and you have somebody else taking the other side of the trade. Remember, it's a blood sport. It's you against the other person, a zero-sum game. And the exchange is providing you with the tools that you need to make your bet as you go forward. Now, what happens with a leveraged long? This is a key piece here. So suppose you believe that the price of Bitcoin is going to go up. You could open a long position with, say, 10x leverage. I do not advise doing this. There's the 3Ls of 3Ls of investing. You got to be careful of. Google that. I don't want to mention what they are, but it's an old expression. One of them is leverage, so be very careful with that. Now, this means you deposit 10% of the value of Bitcoin you want to buy, and the exchange would then lend you the remaining 90% of the Bitcoin or the position size. And if the price of Bitcoin goes up by 10%, you make 100% profit. That is because your initial investment is 10% of the asset that's now grown to 20%, but you're at a 10x ratio. 10 times 10 is 100. However, if the price goes down by 10%, you will lose 100% of your money. And this is because you will have to repay the exchange the 90% they lent you, plus you will lose your initial investment. And this is the danger. Now, there's a kind of, somebody else had a similar question. And we're going to go into kind of leverage and how the ratios actually work as well. So this is like Gary W., like a follow-on question. And again, every week it's amazing to see how everybody's thinking about the same types of concerns, banking risks and leverage and playing long and short and what to do in the market. So Gary W. says, I'd like to know what it means when I hear that leverage investors have been liquidated. How does leverage even work? So in connection with the first part, this is a simple example of what is leverage. Again, a little bit deeper. So leverage does amplify potential gains or losses of an investment through borrowed money. And margin is a common type of leverage that increases the potential gains, but also the potential losses. And a margin call requires additional funds. And if you can't come up with the additional funds, they liquidate you. And they will not let you be in a position unless they have access to your funds anyway. So that's very, very important. It's not like you can stay in the position until you refund it. No, they'll have your collateral already locked down, so you can't do anything. Leverage is risky, and you should know the risks before using it. And liquidation can also be costly. Again, if you get into a big, imagine you got a 10 Bitcoin and you do a 10x leverage on your account and things go against you, you can lose everything in a heartbeat. And let me give you an example of what that means with a graphical image. And it explains to you the relationship between the alpha, the potential gains, but over time, if you use leverage, you'll probably lose. So in this chart here, you will see, I wish I could draw on it, but cast your eye. Let's just take leverage level 5. That's a 5x leverage. It goes all the way to 20x leverage. And if you pick an asset that has a 30% return, so imagine Bitcoin can go from 10,000 to 13,000. Or 15,000 to 45. Oh, sorry. Well, anyway, 10 to 13,000. Simple example. We know Bitcoin's gone up like 80% this year, but just assume that is your given alpha. Remember, the assets go like this. They go up and down. It's not a straight jump to 30%. If you do that and you expect your alpha to be 30% and you use 5x leverage, there is a 72% chance you'll be wiped out in any given year. Okay, with that same type of alpha. Even if the alpha is 100%, guaranteed your asset will double. Okay, and you use 5x leverage. There is 5x, 100%. There's a 56% chance you'll get wiped out in any given year. Hence, I do not use leverage or crypto. It's way too volatile. I do use margin, which is a form of leverage, with equities. It's much easier to play. But with crypto, it's too violent. You don't know what's going to happen from one day to the next. Therefore, preserve capital first, but don't use leverage second. So I hope that it really explains. Keep this table on hand. And remember, even if something is going to double, you can still lose everything very quickly using leverage. And the story gets even more extreme the higher you go. 20x leverage with an asset that promises 85% or 100% gains, 85% chance you will lose everything. So when you hear people saying, oh, I do 10x leverage, 5x, 20x, 100x, they will be wiped out. It's mathematically there in the table. So just remember that, everybody. Don't use leverage unless you really, really, really have a absolute sure thing in your hands. Next question. This is from Alyssa. My child's father passed away and I have to set up a trust for him. It has to go through a bank and I cannot invest the majority of the funds myself. If you had to choose between ticker QCRH and Merrill Lynch, who would you choose and why? QCRH is smaller and family and friends and friendly, it seems, but who will make better investments for my children in the long run? So this is such a tricky topic, and I'm going to be brutally honest with you. So first of all, I dug into QCRH, never heard of it. It's some Midwestern operation that works across 5 states, and I looked at everything you could imagine. But I looked at a investor report that they issued in January 2023, very new, and they were boasting about one thing, and that was the biggest red flag I've seen in quite some time. So they were proud, okay, that commercial loans represent approximately 90% of their loan portfolio in billions. You can see here the commercial real estate being that big blue block. And as you know, that is scary. And if you watch this channel, you'd know why that's scary. This is why. So the CRE Nuke, as we call it, nuclear weapon, CRE stands for commercial real estate. It is a financial disaster. There is a financial disaster coming in commercial real estate. There's no ifs, ands, or buts in the United States and probably other places in the world because things are structurally different now. And small banks hold 70% of this bag. And this bank, it is 90% of their loan portfolio. So it's going to blow up, all right? I know the US government, according to JP Morgan, is preventing people shorting assets, banking assets. But I tell you, I'd look very hard at shorting this stock on Monday morning because of my research over the weekend. Now, this is another one that supports that. Small US banks hold 70% of commercial real estate loans. You can see this has driven up dramatically since 2008. And why? You know why? Maybe, again, tinfoil hat firmly attached here, maybe it's part of the master plan. Screw the small banks. Let them carry the commercial real estate bag because we know it's going to blow up. But anyway, could be wrong. But that is scary. Why? Why do the big banks not hold all of that? Crazy. And actually in yesterday's video here, you'll see exactly the deposits held by the big banks. The top 10 own 2/3 of all the deposits in the world. How come all the small banks own 70% of all the commercial real estate loans? What's wrong with that math? Anyway, let's talk about the other option, Merrill Lynch. So the first one's off the table. Merrill Lynch is your other option. The pros is they are large, well established. They have a wide range of investment products. By the way, the other company, QCRH, whatever, doesn't. They have a strong team of investment professionals. They work with the biggest, richest people on earth. And they're committed to providing clients with the best services, advice possible. However, they are expensive. And that matters too. And once you hand over the keys, they're in control. Now, let's talk quickly about financial advisors and fees and how they eat into money. And I've covered this before. And if you guys want me to explain it in greater detail, I'm going to go real fast because I've got to go through 12 topics today. But this is a visual as how much a financial advisor can cost you. And this is from whitecoatinvestor.com. You can look it up yourself. So in this example, watch the blue line. This is $100,000 per year using a financial analysis. And gold is your do-it-yourself. And there is a doctor in this example. They had a portfolio of $10 million when he retired, hired a financial advisor to manage his portfolio, and the advisor charged 1% of the portfolio value per year in fees. You could do the math. 1% of 10 million. Now, this meant that the doctor was paying $100,000 per year in fees to the advisor. Now, the doctor's portfolio grew to 13 million over the course of his retirement. So it went from 10 to 13. However, he only spent 3 million of that money and he left the rest to his heirs. So the heirs, okay, this is the key part, only received $645,000. And the advisor ended up with 4.35 million of the doctor's money. And the do-it-yourselfer, same thing, $10 million portfolio, retired, grew it to 16.2 million. Notice the difference in fees and the impact. First guy got to 13. The guy who did it himself got to 16.2 because the fees weren't taken out over the 25 years of retirement. And he spent 3 million of the money during his retirement. And the heirs collected 8.1 million, of course, after taxes. That is the difference. And that is how much fees eat into the retirement or the funds that are put aside. So do with that as you may. And financial analysts will help me, but this is a true case from whitecoatinvestor.com. Check it out yourself. I have multiple other examples of how this, even just a 1% fee, can gobble up returns. And even if an investor is expecting the advisor to match S&P 500 returns, I can also prove that the S&P 500 returns on average will not get you where you need to be, okay? Because money debases faster. So you're actually going negative over time. And you take out that 1%, you're removing 1/8 of your actual retirement as well. So it gets even worse. It's like amplified to the downside, which is not good. Anyway, let me know if you guys want more on that. Next question is from Champion Grubs. I moved all my assets off Binance before they shut down US customers. They will not give me my transaction data, and I have a bunch of missing cost bases, and you probably need this for tax returns. Is there a way of tracking this info down? So let's look at the terms of service from Binance. And first off, Binance is required to give you your data. So I suggest contacting customer service. I know that's kind of futile with a place like Coinbase, etc., but you have to try them again. Show them their own privacy policy that states the following. And you can find this on binance.com/en/privacy. And Binance is subject to the General Data Protection Regulation, GDPR, and the CCPA, the California Consumer Privacy Act. And Binance's privacy policy explicitly states that they are committed to these data protection laws. And if you're contacted by customer service and they are not able to help, they have to help. And it's best to use Binance's special email address to exercise these rights to get your data. They have to give it to you. So otherwise, kick up a storm, but they have to give it to you. By the way, there's been some funny news, because you did mention Binance, just over the last few hours. This came out that Binance is temporarily experiencing closed Bitcoin withdrawals. I don't know if people are experiencing the same thing, or some people were, some people weren't, depending on where you are in the world. But there is supposedly a network congestion issue. And our team is currently working on a fix until the network is stabilized, and we'll reopen Bitcoin withdrawals as soon as possible. Rest assured, funds are SAFU. When I hear that SAFU right now, after everything that happened in 2022, I get nervous. And then Joe Consorti, shout out to Joe, he said Binance has seen 175,909 Bitcoin leave its exchanges in the last 24 hours. That's 30% of their total Bitcoin balance gone. And the reason 30% is important is because First Republic failed after 1/3 of its depositors vanished. So I don't know what's going in here. If you have a Binance account, be careful. Don't hold any Bitcoin on exchanges. And this is potentially scary. Next question is from Crypto Bones. I'm looking to buy, refurb, and sell a property within 6 to 8 months. Do you think I would be selling in poor market conditions? Small scale domestic property. So first of all, I hope it's not a commercial property. It has to be residential. Don't touch commercial right now. And also, I don't know the 3 rules of real estate. I don't know where it is. So location, location, location. And we'll talk about why that's very important in a second. First of all, the refab, is it possible in 6 to 8 months? Yes, it is. But these are the rules that you need to adhere to. And I've done a ton of these in my life. Ensure the structure is sound. You don't want any surprises. Do not make any structural changes because you'll have to get permits, and they can take a long time to get and also cost a lot, etc. And make sure you're only making cosmetic changes like paint, floors, etc. Maybe windows, it's all simple stuff. Focus on making the kitchens and bathrooms really nice because buyers tend to look at that. So if you're flipping, make them pretty. They matter the most, and you get most bang for your buck. So if you invest, say, $10,000, $14,000 in a kitchen or bathroom, I've done a ton of bathroom renovations and kitchen renovations for kitchen cost, typically cost 14 if you do it right, bathroom at least 10K. But you can make, the increase in the value of the place go up by 5x that amount if you do it right. Also, Time is money. Make sure it doesn't run long, and do as much of the work yourself as much as you can, and make sure you have a crew for the tough jobs. Okay, but you got to be very hands-on to make this worthwhile. If you're just outsourcing everything, they'll eat into your profits. The final thing is, regarding that time, make sure you can do it in 6 months, because in 8 months, you'll be going into the death of the market. Nothing sells between middle of November and middle of January. So remember, and if you're sitting on an asset for sale and you're not able to sell it, that also burns a hole in your pocket. Now let's talk about location. Well, no, talk about Case-Shiller first. This is the Case-Shiller chart I pulled up. And if you look here, obviously the trend has been down. We forecasted this downturn in real estate. Had to happen. It's happened. But the great news is, as of like a week or 2 weeks ago, there's a slight uptick in the price. So it looks like real estate has bottomed out. Now remember, people are like animals. They nest in spring. We are now in spring, and therefore people do buy new properties at this time of year. April, May, June typically are very, very good. We're in the middle of that right now. That could explain the uptick. It doesn't mean if there's a further banking crisis or lending stops from banks that the market won't go down further. I suspect it probably will, especially in commercial real estate. And why? Let's look at the other most important thing I mentioned, location, location, location. I call this follow the bodies. Watch the migratory patterns of where people are going. Go to where the blue is. Do not do this where the red is, okay? Look at the blue on this map. And I couldn't find these for other countries around the world, but I'm sure they exist. I know they exist in Australia and other places. But follow the bodies and also follow the jobs. Because real estate will do well when there's a lot of job growth. But if you look at these big regions, Pacific is doing okay. The West North is doing okay. Mid-Atlantic is doing okay. And New England's doing okay. But the South is not, unless you're in places like Miami, etc. And that could only get worse with more automation and AI. So make sure you're in one of the growth areas as well as you go forward. So there's one final thing as well. So the flipping business is suffering right now. That's when people buy a place to flip them. And this is a statistic that shows you that investors are dumping at a faster rate than they have done for the last decade. So investors own 1 in 10 homes for sale. And you can see that they are selling much faster than historically. So you might be up against a lot of competition. If all the people that own multiple houses start dumping them at the same time, that'll mean a glut in the market and price could fall. So beware of that too. Excuse me. Next question is from S22. Which country has the least inflation and why? Whew, good one. So a little bit, I wouldn't say I'm biased in this one, but I knew the answer when I saw the question immediately. And that is Switzerland. So this is all the data of inflation for Switzerland, for the EU, the USA, and planet Earth over the last 40 or 50 years. I can't see, I have it on the next slide. Let me find out how far back I went. Went back to 1980, so we'll call it 45 years. Switzerland is the blue line, and they are historically below average, sometimes often very, very negative too, deflationary for much of the time. Green is planet Earth. Obviously, it has a lot of places that have crazy, crazy inflation. Turkey, Lebanon, Argentina, etc. Red is the EU. Historically, and these are kind of moving averages, so hey, Stefan, so take them with a grain of salt, because the EU inflation currently is a lot higher than the US, but the US spiked first, and the USA is in yellow. Another view of this data, and as to why, so you can check these all out for yourself. You can see Switzerland is a strong economy with low unemployment and high growth. Also stable government with very, very sound economic policies. The central bank, or the National Bank of Switzerland, always knew what they were doing until, of course, they had to bail out Credit Suisse and arrange that situation with Bankverein, UBS. And also, they have low levels of government debt. That's very, very important in places like the US and Europe. They are beyond escape philosophy. They'll never be able to pay back their debt. And they have high levels of foreign reserves because people park their money there. That's why Switzerland, their whole basis of their economy is to make the currency attractive for people to park assets there. Like Switzerland, think of the Swiss franc like Bitcoin. It's kind of like a safe place to park cash. It's also secret, etc. So that's why Switzerland and the Swiss National Bank keep inflation low. And I can remember a time when the Swiss franc was worth half of what a dollar is. Now they're kind of parity. And that's because the Swiss are very good at managing money. So with that, everybody, thank you so much. Helping animals. This is Munchie. Somebody crossbred a mini and a sorrel, which caused a lot of problems for this dwarf and needs a lot of medical support and help. And we do that. So now I'm going to answer some cool questions from you all. Q Robin. Sorry, I'm thirsty. K8, T&D, Benny, Rusty, Beardy, Womble, Vicio, Mad Cow, Tupperter, Iron, Clint, Brocade, Babushka. Great to see you all. Good to see you all too. Thank you, Kiwi Robin. I appreciate you being here very much. Let me see. Oh yeah, this is a good one. Next question is from Bill Whammers. Let me pull this up for a second. He said, your thoughts on Buffett and Munger's comments on Elon this week? I think it was yesterday in the conference that they answered a question on that. And it was kind of weird. And I thought when I was watching it, there's a show I remember as a child called The Muppet Show. And there was two grumpy old men on The Muppet Show. And I don't know their names or anything else, but, I think I tweeted it after Elon today. So they were just weird. Bill, I think Charlie and Warren, they are legends, but they're way beyond it. They don't get it. They're beyond stuck in their ways. They were asked a question, actually, I think on Friday, as to how much Apple they hold. They even got that wrong, because they don't even know what's in their own bag. I just think they're past it. They did say some good things, that Elon is super, super smart. I think Warren was more complimentary to Elon. Charlie, I think Charlie's just negative on everybody right now. So that's all I got from it. I can't say anything else. But I think those guys, I'd love to be kicking at 90, 100, 110, however old these guys are. So respect to them for doing that, but I just think they don't have a firm grasp on what's going on in the world, and they definitely don't understand technology, and they definitely don't understand disruption, and they also were a little bit unfair in the way they were pumping BYD bags for the last 6 months on TV, etc., saying it's a superior company when they were selling it at the same time, and I thought that was very sleazy. I believe in true open transparency. And Nick M, thank you so much. Iron, thank you for sharing wisdom. My pleasure. MT, good to see you, buddy. JMG7825, will you be doing an update on how to retire series? Yes. The compendium score for Solana, I can pull that up right now live. I can tell you the SEP score is through the roof. It is the best, the compendium score for Solana. Where it ranks, bear with me 1 second, I pull this up. Z2A. Takes a while to crunch. So out of the top 500 cryptos, Solana compendium score is in the top, it's basically eighth in the top eighth best out of 500 cryptos. So that's where it ranks. And yes, I will do an update on kind of price levels. A lot of stuff has changed. Unfortunately, there are names that got stuck in the downdraft. But my long-term thesis for these crypto assets has not changed. And I tend to jump into something and not waver. And that's very, very important. When you jump around between assets, it can be very problematic. But I get in early, get in hard, and see what happens. What happened, unfortunately, with Solana was bad, but the data has not changed. In fact, the data is beyond my wildest dreams of where they would be after we first started talking about it in March 2021. And again, run the data models, look at every single aspect, look at 69 different parameters, analyze them, compare them, and that's where the result comes up. And that's how it's easy to see what's happening. Crypto Ninja, do you believe the CRE nuke will have a big impact on residential real estate prices? It depends. The problem is, if you imagine, so commercial real estate, as we showed, is 70% funded by small banks. When it blows up, that will deplete their ability to lend for residential investors. And having that loss of liquidity will dry up the whole market and crash. The only people that will be able to buy homes will be people with cash. They will not be able to borrow because small banks won't lend to them. And big banks have very, very strict regulations, so you won't be able to get a good deal, which will drive up the cost of financing, which will drive down the price of the house. So I think, yes, there's no such thing as things being idiosyncratic. Silicon Valley blows up, Silicon Valley Bank blows up. People say, oh, it's idiosyncratic, it's not going to impact anything else. Then everybody looks at their deposits in all their banks and start running on the banks. And that gradual run has just continued. And again, I think, as I said many times, the banking system cannot function with the rates at the current level. All right? Spoke about this for years. I spoke about financial Armageddon if they go beyond 350, 400 basis points. Here we are. Everything's going to break. It's happening with bank runs. It's happening with big banks hitting the wall. It's happening with all the money flowing to the top 4 banks. That is not a good thing when JP Morgan's in control. I spoke a bit about JP Morgan yesterday about the rumor that they are short gold and China is trying to squeeze them. So super interesting case. But they broke everything and the Fed is just screwing the pooch and they have 320 PhDs. They can't all be idiots. Therefore, they're doing this with a mission in mind. What that mission is, we'll see. And that's what makes it a scary and fascinating time to be alive. It's like very exciting macro things happening in the world that I never thought I'd see in my lifetime. So yes, Crypto Ninja, CRE Nuke will hurt residential, no doubt. Brendan Thielman, James' Patreon is good, guys. Some of these guys are absolute pros, lots to learn. Thank you so much, Brandon. I appreciate that and love everybody in the community. And it's these questions that help me sharpen my tools. So all the questions that come every single day in Discourse, Discord, etc., in the community chat and Patreon, help me get better every day. And I am starved for learning more all the time. So answering these questions helps me get better, learn more, and share more with you all as well. And thank you as well for everybody out there. Tesla Bull Believer, Iron, Glenn Johnson, Dog1, KN, Mike from St. Jude Needs Us, A Bottle of Red, P. Dragon, 183, AC1, Viciously, of course, Kiwi Robin, Stephen Weston. Thank you, buddy. Don't worry, I did promise you good data in April, and it came to fruition, and it's even getting better every day. Long-term holder, Andy, and I'll see you all tomorrow morning for DCA. It's going to be at 4:30 Swedish time. I think that is Central European time. And that would be 3:30 UTC, 7:30 a.m. Pacific, which is 10:30 a.m. East Coast United States. So thank you everybody for being here. Thank you for spending the Sunday with us. A lot of work goes into this, so all we ask is hit the like on the way out, and I'll see you all tomorrow morning first thing, and keep those brilliant questions coming. It's a scary time to be around, but it's also exciting because we are prepared. We're ready for this. We didn't think it would happen until maybe 2028, 2030, but it's happening a bit sooner than expected, but sometimes that happens. Risk happens fast. See you all.